Today on the Brew, we are going to discuss execution quality, or EQ. It has a lot to do with retail trading and the market makers on the other side. So let's get into it on the Brew. Hey, good morning, boys. How are you?
Morning, Lex.
Awesome. We're back. Today, execution quality. So let's get into it. Mark, I'm going to start with you. You're the guy. I read your blog, by the way. I really liked it. It was excellent. It was called The Wheel or something like that. What's the exact title of it?
I think it was called Spin My Wheels or something like that. I think I had a nice little pun in that.
Yep. Very good. So EQ, execution quality. What the heck is this? What does this mean?
I think this is a fascinating topic because it's in the world of trading and, options markets and the options industry. This is all people talk about, retail order flow, but retail generally doesn't think about it. They see a lot of the implications of it in their fill prices and whatnot. Mm-hmm. But EQ is for all retail trades that come in. And so there's certain characteristics of what defines a retail trade. It's coming from certain brokers with a contra type, but it's also a certain size too. So these are orders less than 250. Mm-hmm. So EQ will only apply to a subset of orders, but it's the measurement stick that market makers, wholesaling market makers use to demonstrate to brokers, Schwab, Fidelity, E-Trade, Tradier, of course, how well they're doing with their execution. Mm-hmm. And so when they buy the order flow in exchange for executing that and trading that and taking the other side and bringing it to the market, they demonstrate their effectiveness through price improvement, through improving the lit markets through auction mechanisms.
Okay, stop there for a sec. So we have a market that's, I'm just going to make this up, 1 to a dime, 1 to 110, $1 at 110. Okay, so retail folks can easily pay 110 or easily sell it at $1. This EQ measure for the retail folks tells them how much inside that 1 to 110 market makers are willing to shave their prices mm-hmm. to complete the order. Is that right?
Yeah, and I think that's a great demonstration of what this is, right? It's how much market makers are willing to improve the lit markets for this subset of order flow. Yep. If they say, I know with this type of order coming mm-hmm. from these brokers meeting these qualities, I'm willing to give it a better price. I'm willing to pay to give it a better price because I know enough about it in advance. And I know that it's non-toxic, and I know that it's generally going to be random and uninformed.
Sure. So that's, all those points are great. And I talk about this a lot when I travel to these summits. And it's important for the retail people to know this, I think, right? I don't want the retail folks to come away from this thinking that their order flow is dumb necessarily. That's not how we treat it. It's not dumb. It's just that the way they have to transact their business is they have to pay the price of eggs. And the price of eggs is an offer price, right? And you might get a little bit of a shaving discount to that price if you're non-toxic. You said a great word there. And non-toxic to a market maker is very important. That means that you have very little knowledge of market movement or direction, right? You're not an institution who has inside some kind of information, and you're just trying to transact and buy your eggs or sell your eggs for that matter. Yeah?
Completely. And kind of it's the lit markets, the MBBO, the advertisement of, where you can trade also represents the price of asymmetric information, right? Dealers are putting out bids and offers and they don't know who's going to take it. They don't know that someone could come and sweep everything, whereas if you see this order flow coming from these places and being non-toxic, you can give it a lot better price than what you're just willing to show out there for anyone completely, exposed and naked to the wind.
Sure. So how is this measured? I mean, is this a quantitative kind of measurement that a retail person can go to a website and say, this market maker is getting 32% better. This one's doing 27%. Is that available? How is it measured?
So there's sort of two components to the whole mix in terms of the way the price of customer order flow trades.
Mm-hmm.
And like with those EQ levels, like not to get ahead, but like what it indicates, but like in some ways that's the price that dealers are willing to shave from asymmetry for this segment of flow. It's how informed that is, how valuable that is to their trading. And the more valuable that is because of its uninformedness, non-toxicity, the tighter those spreads are going to be relative to the lit markets.
Mm-hmm.
So what can get, and there are two components. There's the payment component and there's the price improvement component.
Mm-hmm.
So payment is available. You can look at that in like the 606 reports, and like they're publicly required to disclose how much, payment they give.
Right.
The percentages, and it's actually not measured in percent. It's counted in pennies, but denominated in percentages.
Okay.
But basically how much of the spread you improve. And that's not visible, to be clear.
That's not visible. Okay. But it's probably visible to the brokerage community who deal with the market making community, right?
Yes. So Tradier will say to order flow counterparties, or maybe vice versa, they'll say, "Hey, Tradier," or you say, "Hey, we're getting paid for this flow. You guys are only delivering a 35 EQ. We expected 30." At the end, when you count up all your pennies against all the different markets, you say, this number was higher or lower. Or, great, you guys gave us 29 this month. Congratulations, you're now 20% of the wheel instead of just 15% of the wheel.
Okay. Jason, what do you think about all this? Anything?
No, I mean, so for a little while, and it's something that we'll probably put up on Volend at some point, but for a little while, we track probably a little bit different of a calculation, but we track how far away from mid prices dealers are executing their option orders. It's somewhat similar, but I guess it's different. It's not a broker dealer thing, but it's kind of, it tells us though how much of this liquidity, and we also don't differentiate between toxic and non-toxic orders. The Marks of the world versus the Lexes.
Mm-hmm.
Not sure who's who.
I know who he's thinking is the toxic one. I get it. Look at this hair, my God.
But so we don't like differentiate like that, but it's kind of like a measure to us of liquidity and how much the dealers, for them it's like dealer edge, how much of the dealers are claiming for each transaction. Mm-hmm. Because they're trying to make the spread between the bid and the ask by taking it away from the bid and the ask. That is inherently cutting into their edge. Mm-hmm. So it's something that we kind of measure, and it's showing us a little bit about market maker book and kind of activity. Mm-hmm. Mm-hmm. So I think until Mark tells me I'm wrong.
It doesn't sound like he's gonna. Yeah. So having said all this, I mean, does this mean anything to the retail person, truly? Or I mean, what do we have to take away for that person? Is there a takeaway?
Well, yeah, I think it's very meaningful to the retail person. How much price improvement they get on an order. The difficult thing is it's random, and it's like, you don't necessarily know when to expect it as a trader. Mm-hmm. Sometimes you'll put a midpoint offer or bid in, and all of a sudden you get filled immediately. And other times, you got to fish all the way to the other side. So it's definitely not like a consistent experience. Like these numbers are mm-hmm. Overall over the course of the month. So, some pennies get given here, some pennies get given there. So, sometimes that can be confusing, but I think some interesting like best practices that you can really you're going to put in an order, you see a market that's like $1.10. The figure I like to keep in mind is like 30 or 40, mm-hmm. That a little better than half the difference between say the bid and the mid. So if the market's buck at $1.20.
First and third quartiles, right?
Okay, don't get confusing on me. So let's say it is $1 to $1.20. 110's the midpoint. What does the 30 represent if someone's trying to buy that option contract?
So like a 30 EQ market on a buck at $1.20, mm-hmm. $1.10 midpoint would mean your true bid ask is $1.07, $1.13. So that buy side would expect to pay 113 and the sell side would sell at 107, as opposed to, so you're getting 7 cents on either side.
Okay. And how does the 30 compute into that? I'm not doing the math well in my head.
It's 3 cents over 10 cents. So the available pennies are 10 and the, given pennies are 3.
I gotcha. Okay. Interesting.
That was the moment where retail can actually for front run Lex's understanding real quick.
That's right. My God.
30 cents equals 30%.
Well,
but it gets wonky because you're calculating it in pennies.
Yeah.
Right?
Yeah.
The way they average it is on each order, they count up all the pennies and it's pennies given divided by pennies available.
Mm-hmm.
If you did it by percentages, you get a different answer. Like if you weighted each order as that's a 30% improvement, that's a 47% improvement.
But 30 represents 3 cents in parlance.
Well, 3 cents equals a 30 EQ on that single order.
Okay.
But if as you aggregate those orders, you aggregate the pennies first and then do and then produce a figure, as opposed to weighting the percentages.
Right.
Yeah.
Right.
See, so that actually doesn't necessarily that method of calculation doesn't necessarily do anything for liquidity, because $1.20 is more liquid than $1.40, and if the EQ would be double the instead of it being 3 cents from $1.10, it would be 6 cents from $1.20. So it's actually less liquid, but the EQ would calculate the same.
Yeah, that I imagine when you're looking at spread widths, you're doing it the way that seems mathematically correct. So to speak, is that you're weighting all the percentages and whatnot. I totally agree. When I first learned about this, I'm like, wait, that's the arithmetic? That's how we had to redo our system because I just assumed it was weighted averages.
Right. Oh, that's funny. So what's the best? Write the prescription for the retail trader. What is there? How would he or she use this information? Is it? I mean, my other point was going to be, who the hell cares in spiders for that matter? They're a penny wide, so that's a pick 'em market. So.
Well, some of that which is amazing for trading, right? Like for any buy side to have that depth of a market, fantastic. Don't worry about anything. Take the offer, move on, execute your strategy. When you get to those wider markets or even spreads, you put on a condor and SPY and it might be 4 or 5, 6 cents. That happens.
Mm-hmm.
So I think that 30% rule is huge. I think that think about that. If you've got some width to the market, go for that 30, 40% number. The other dynamic is that not all orders are going to be treated exactly 30. That it might, because of the microstructure of how that order goes out to a wheel, trader, you're sending some of your flow to broker X, you're sending some to broker Y, and you're sending some to broker Z. Depending on where broker Z might be in their whole calculation of where I want to give improvement or not want to give improvement, they may or may not get that given order. So it's going to be counterintuitive. It's know when to hold them and know when to fold them, but sometimes it's worth cancel replacing. That can definitely be an effective, sometimes you'll re-trigger an auction, prices have moved enough that it's interesting. So sometimes it's worth it, but other times it's worth it to keep your order floating out there and demonstrate your non-toxicity, that you're not trying to ping for anything. You're just, if you're putting on a strategy that has a little bit of a delta and it floats a little bit to some market maker's edge because of the delta, cool, move on. You get your 37 cents or whatever you expect it to collect. Demonstrate your non-toxicity by remaining static even as inputs move.
Mm-hmm. Yeah, that's interesting. Okay. What about this wheel thing? You keep mentioning the wheel. Let's explain that if we can. I'm assuming it has to do with the market making side, the liquidity providing side. They're on some kind of rotation of who gets what. Is that what we're referring to here? Or is it something else? I know it's beyond that, but what else is it?
No, I think that's exactly right. That, as a broker, you have this valuable commodity that is, order flow, and you want to get it. You want to get the best price for your customer and provide the best, execution experience for your customer. And so to do that, you solicit a bunch of counterparties to compete for that flow, and they compete for that flow by paying you a little bit of money to execute it because they desire it and it's for its non-toxicity, and they, demonstrate the price improvement. So you parse out a little bit of your flow to all these different counterparties and kind of have them compete. So a random order comes in and, this slice of the pie is going to go to market maker A. This is going to go to market maker B. This is going to go to market maker C. And as those orders come in, you randomly send them on the wheel to whoever's up next, whoever needs orders to get to their target percentage level. And it happens randomly. Sometimes a 250 lot or 249 lot comes in, and sometimes a 2 lot comes in. And so it can be arbitrary which person ends up, trading any marginal order. But, broadly, you're looking to slice it out a bunch of different counterparties.
Yeah. So if a broker has a managed route, okay, or maybe an unmanaged route, but what I mean by that is their order flow goes through this tube, okay, and it's not specifically sent to any dealer particularly. It's sent to the community, and the community bids for it, sort of, right? So how does Citadel grab that same order over Susquehanna? Or is it just a random spot on the wheel, or can they compete against each other to improve price before it goes to Citadel versus Susquehanna? Do you know what I'm asking?
Yeah. So where they compete is at the exchange level, that the broker will manage their wheel. And so say trader has 3 partners and you're going to give them each a third. And that's like your agreement that you guys each get a third, and you all have to give me 30 EQ and 50 cents, like, a contract.
Sure.
And so as a 930, 10 lot comes in, first 10 lot just goes randomly to the first person. Another 5 lot comes in. That's going to go to one of the other 2 people that didn't get the first order.
Got it.
And then 50 lot comes in, and that goes to the third person. So now they're imbalanced, and each marginal order starts filling out, as you get that order flow, as you're trying to balance each of them getting their target percentages.
But that's all done electronically. It's not like some
It's just an algorithm to randomly allocate their flow.
Okay, and it sounds like it kind of equalizes the liquidity providers more or less.
Exactly, and so they get that order. So that order will come to a Citadel or a Susquehanna, and now it's their job to bring it to the exchange and trade it. So this sort of all happens before the exchange. There's a pipe between the broker and the market maker that says, "Here's my order," and the market maker says, "Great." And they decide either to post it if it's non-marketable. If it's a limit order, be $1.20 market, you get a 115 bid. They don't want to trade that. Maybe they just post it. Maybe they get a 102 bid and they just want to post that.
Sure.
Or they want to trade it. And so if they want to trade it, they can just post an order on a market and then it's lit and anyone can take the other side, whatever. If they want to trade that and take the other side, say that is a 115 bid and they want to sell that, it's got a nice nickel of edge. They bring that to an auction mechanism at any of the pro rata exchanges, SIBO, PhilX, Amex, and initiate a price improvement auction. And at that point, there's the initiating party, which is the wholesaler that got the order. And then all the other market participants, the Optivers, the Group Ones, anyone in the world that wants to pay 10 grand a month for that feed can see those and respond within 100 milliseconds, can see what's going on and compete for that price improvement. So the competition happens at that exchange level in the price improvement auction.
Okay. Quick question. I understand all that. So let's say in our example, Susquehanna wants, it's 10 lot. Susquehanna gets it. They get up on the wheel. They want to trade this order. They want to sell this order at 115. Retail customer buying, right? Do they get 100% of that order if they want to trade it at 115, or do they get their DPM percentage, if that still exists, and then the rest goes to the market making community to compete for?
So in the auction, it's not necessarily a DPM, but the initiator of the auction does get a priority. And this is really getting into like microstructure rules. That priority is slightly different on the PhilX versus the SIBO, for example. And they also get, so what'll happen is Susquehanna will initiate that auction and they'll say, I want to sell this at 115. I got a customer buying this. And that gives them a 50 EQ if it trades right there, right? Halfway between the mid and the bid or mid and the offer, sorry. And but then everyone else can come in and say, I see that order and I go, I'll sell that at 114. I only need 3 cents of edge. I'll sell that at 113.
Right.
And the initiator can opt in to auto match any level that will come in. So Susquehanna can initiate that and say, I'm launching this at 115, but I'll match down to 112. And they get their priority all the way down to that level.
Right. But if
There's
they
also some of them are visible. Sorry, I'm getting real wonky on
no, that's good. I like it. I just want to make sure it's clear though. I'm gonna restate it for a second. So Susquehanna gets it at 115 in our example. If someone's willing to price improve, they cannot trade it at 115. I want to make sure that's clear. It's got to trade at the new price improved price. And if Susquehanna wants to participate there, they can. If
exactly.
they don't, they lose their 115 priority because someone's going to better the market. I want to make sure the retail folks know that. It's important because they're not getting scammed at a worse price because of this wheel. They're going to always get the better price.
And there are two mechanisms. There's a mechanism ex post where they're reviewing the order flow that like the brokers are like, doing all the numbers and saying you're meeting your targets, you're not meeting your targets. So that's happening at a very high level.
Yeah.
But then as every order trades, it's happening on an auction by auction level so that like you can't sneak something by. You can't be the fox guarding the hen house that puts a 50-cent wide MBBO out there or BBO out there. Someone's going to compete that. Someone's pushing that market tighter and making you meet your levels. And then they're finding you in the auction to trade that if it's going to trade for too much edge.
Right.
So all the way down the thing, retail's getting improvement.
Yep. Interesting. Yeah, that's fascinating.
You put in your best bid and offer, but you don't get that as the actual bid until somebody gets you up there.
Yep.
Right?
Very
and
cool.
that's what's confusing about some of the dynamics of this is that like, have you ever put in an order, like say you've got that buck 10 market or buck 20, then my numbers are easier. And like you put in like a 117 bid. You're like, I'm paying up for this. I don't care. I want this. You put in a buck 17 bid, nothing happens. And maybe it doesn't improve on the screens because it's a spread or whatever. So it's sitting in the spread book. You got a buck 17 bid. You're like, come on. And then you go and pay 120 and you get a fill back at 116. And has that ever happened to you?
Yeah. Well, yeah. But so what's going on there? Why does that happen? Because you have a limit order that's better than where you're going to get filled. I don't understand that.
It has to do with the incentives and the exchange fees and all. So it has to do with the wheel helping you out. And it has to do with some like weird fee incentives. So if that order is 117 and just sitting out there on the books, then that goes in the non-marketable bucket. So there's a different deal for non-marketable flow versus marketable flow. Non-marketable flow, someone's trying to improve the bid or offer, so it's just going to go sit out there. If someone wants to trade against it, first of all, it doesn't count for your one EQ bucket. So why would you give it that level if it's not counting for your marketable bucket? And then it's sitting out there, so no one's going to trade it because there are big take fees to trade it.
Right.
But if someone sends a marketable 120 order, that now goes into my EQ points bucket, and I'm willing to trade this for only 4 cents of edge, or 6 cents of edge, and sell it down to 116 because I get the points or the pennies for that EQ price improvement, and I don't pay the take fees because I'm doing this in an auction, so I might get a rebate, like especially if someone else trades on, so there are like microstructure incentives for why that might happen. So it's a counterintuitive point, but like if you're not getting filled in the mid, take a shot and lift an offer or hit a bid. You might get some improvement on it.
Right. Especially on spreads, right?
Especially on spreads. Yeah. And they're their own EQ bucket. So they parse all these different things down to marketable spreads, non-marketable spreads, penny names, non-penny names. Like each of these, the slices and tranches of the flow has their own EQ targets and expectations.
Yeah. Interesting. When I was a boy and I used to walk to school in the snow uphill both ways, and trade these things on the floor, there were instances where you would trade on one exchange, a spread especially, and then look, if I'm on SIBO, Philex would get wind of it and say, hey, I would be willing to do that spread a nickel better. And then broker A would come back to us in the pit and say, guess what? Philex would have done it a nickel better. Can you give me any improvement? Remember those days?
Well, and that broker has his own incentive because if he goes away and trades on the Philex, he doesn't get paid.
That's
he
right.
Needs that to trade. He needs you to trade that at 115 because
That's
otherwise
right.
his $2 is gone.
And what would we do? Sure, we'll trade it there, right?
And yeah, it's or maybe he didn't call the Philex and didn't know that offer existed. So you're all happy because it traded 120.
Yeah, the good old days of manualness. Now this, as Mark described this whole process, right? This happens in milliseconds, all this stuff, right? It's just instantaneous, the way this improvement game works.
this is, not quite the Stone Age, but back when I was looking at these numbers, the exchanges were asking if they could bring the time down to 100 milliseconds.
Yeah.
And they surveyed all the participants. Everyone was responding in less than 10. All of this trading happens in like single digit milliseconds 5 years ago. I can't imagine what the realities are today.
Right. No, it's probably fairly instantaneous, at least to the human eye, right? So.
But there are tons of firms that might not even be buying order flow that are responding to these auctions.
Mm-hmm.
So it's not even like your retail order is going down and it's just this oligarchy of 5 people that are all on the wheels. There are 5 times that many participants that are watching these auction feeds and trying to snipe it for their own reasons.
Right. Interesting. Awesome. Okay. What else? Are we missing anything with this one? This is interesting stuff. This EQ. I didn't know we measured this so closely, but I like it.
It shows like, a third of OCC volume is retail roughly, right? And it's a really powerful force in the market. And it's very, competed for, which is amazing for retail traders that it's such a valuable like commodity to all these people that they measure and, compete for it so viciously.
Yeah. Interesting. Jason, any last thoughts, my friend? Jason from Vol.land, Mark from Harvested Financial.
I mean,
read their stuff. Lex from the Hub. We're having fun. Go ahead. Sorry, Jason.
No, it's all right. I mean, a lot of like what my measurement was, Mark's right. It's not exactly EQ. After reading his blog and he kind of slapped my wrist on Twitter, it basically
gently, I hope.
What?
Gently, I hope.
No, it's fine. No, I'm always open to being corrected, especially by Mark. Lex, I don't know, but Mark, But I mean, like what we try to see, we're trying to like kind of see like certain liquidity measures, and so what we're trying to do is find what like dealer liquidity kind of looks like. You could see it in width of like, is it $1 to $1.20 versus $1 to $1.30? But there's a lot of variance in that, and it doesn't necessarily mean anything. So since Volin processes all the executions, we try to do some, it's not EQ as measured as the way it's supposed to be, but that's the way the brokers do it. But we're trying to measure kind of a certain liquidity aspect of the underlying. We just use like kind of the 50 delta for now.
Mm-hmm.
But Mark, do you think that's effective, or do you think that's useful, or do you think that's as variable?
No, I think like overall, like if the question is like, where is liquidity, like where is trading happen, like kind of at that like meta level, in some ways EQ only answers a part of that for a very specific segment of order flow and is more about the relative price of that segment of the flow to the overall markets than like what the markets themselves are implying.
Mm-hmm.
Right, that like you're willing to demonstrate improvement on this segment because of its relative toxicity to the overall lit markets that I'm willing to display. I'm interested in it. I'm thinking I wish I had like historical EQ relative to market widths over time would be an interesting question, or just absolutely those market widths and where any order gets executed over time is probably a better measure of like, what is liquidity? Like what is like, how many dollars does it take to move markets, like kind of liquidity, rather than just like how valuable is customer flow.
No, I'm not talking about dollars to move markets. I'm talking about how much edge are dealers willing to shave, in a highly traded market, I guess you could say high equilibrium market. You would think they kind of have to shave their edge more and more and more in order to compete with each other. But if it's if it's a runaway market, or it's going, fast in a direction, and it's going, there needs to be some major hedging going on, and that edge kind of expands. That's kind of what we're seeing. But we're still working on it, which is why it's not like available in Volland or anything. We're still kind of just looking at it and seeing the best way to display it. But
I bet you if you could, to the extent that it's interesting to parse like what the EQ on retail flow or non-retail flow is, I'm just thinking about the data structure that like anything that goes in between markets means it's probably in some type of like auction. So they're broadly the price improvement auctions, the AIMs, the PIPs, all those. But then there's also like QCCs, facilitation, solicitation, that like by definition has to be of a certain size. So it's almost like if you just set a size filter, you have a pretty good, rule of thumb bucket this flow versus that flow.
Yeah,
we do parse it on a size basis, but yeah.
Sorry. One note before we go too. Mark, you mentioned early in the show, but I want to reemphasize it. This sort of information pertains only to orders under 250, because that's the mark to the market making community, the dealers, that you are now all of a sudden more of an institutional kind of player, whether you are or not. Now, my argument is, well, what if you have a lot of money as a retail guy and you can trade 250 lots? You're still non-toxic, but unfortunately you get pinched into another bucket after 250.
Case in point, Lex right here.
I mean, my tick size is like 1,000. What do you mean?
Yeah. My size is not your size
all the time.
Jeez. Oh my God. I can't think of the biggest order I've ever traded as a market maker back in the day. I don't even remember. It might've been like a 5,000 lot or something.
Yeah. I mean, like once you get into like RevCons and stuff like that, or
well, that's different.
Exactly. Yeah. Or like a dividend play. Like we never really did those, but
we did. But yeah, that didn't count. I mean, that was, that was fairly structured. I'm talking about total risk order. You got deltas to cover.
Untied.
Yeah, untied. Yeah. All right, guys. Good. That was a great conversation. I loved it. Any parting words? Anything you guys want to say about your harvested or about Volin before we go? A little advertisement for the boys. Anything? Bueller?
Yeah, join Volland. I mean, it's a great community, but
can you get a hat?
Stay tuned, because there's always new things. There's always new things rolling out. So
all right,
this year is going to be a big year for us.
I love it. Mark, any plugs for yourself? Harvested?
Yeah, take a look at the tape. We that's our software and data analytics product. We track market width there, and not necessarily EQ per se, but overall like liquidity and market width is combining that with some volume stats to
Yep. And you guys are both contributing to the hub. I think Mark, you push is it the till that you push, and Jason occasionally you write some things there.
Yeah, I'm terrible at keeping up with that. Mark is way better at blogging.
Mark's great at blogging. Yeah,
I've got a half one in the books right now, so stay tuned.
I love it. I
love
reading
your inbox later today.
All right, and if you haven't done so already, join hub.tradier.com. It is free, and you get to have all kinds of content from all of our contributors. So we would love to see you there. And we have a summit coming up, guys. Stay tuned for that. That's in late April. We'll chat about that later. In the meantime, have a great rest of the week and weekend. We will see you next time on the Brew Traders Workshop. Live it up. Mark, happy trading. Jason, what's your tagline?
I'll come up with one for next time.
You come up with one for next time. All right, boys. Have a good one.
All right.